everybody. Welcome to The Index. I'm your host, Alex Kahaya, and I'm excited to be joined today by Sunand Raghupathi, co-founder and CEO of VEDA, which is the DeFi engine powering the next generation of financial apps. VEDA enables Web3 developers, asset issuers, and protocols to build consumer-grade cross-chain yield products. Sun, thanks for coming on the show.
Thanks for having me, Alex.
So before we jump into exactly what that all means, I'd like to just hear your story and just kind of why you're here. Like, what gets you out of bed in the morning to build what you're building in this space?
Yeah, my background is actually in academia. Before joining crypto, I was enrolled in a PhD in computer science. I spent most of my time before that doing research, publishing papers, running that rat race. Before actually starting my PhD, a friend of mine from college, this was 2021, so kind of peak bull market, peak froth, DeFi was blowing up. A friend of mine from college had joined a DeFi protocol and sent me a message. He knew I'd been thinking about taking a year off, trying startups, doing entrepreneurship. I'd always been interested in that stuff. So he said, come work with me. So I did and ended up never going back to my PhD. The reason for that is, one, I fell in love with DeFi. I think it's just one of those areas where once you get in and really understand how things work, mess around with it, it really transforms how you think about technology. So obviously there's a lot of nonsense that was going on back in 2021, but the core principles of DeFi, I still very much believe in. And the other point is a point of leverage. I realized, and I'd been thinking about this through my academic career, it's way easier to have an impact in startups than it is in research. It's like you're optimizing for the right things, right? In research, there's all kinds of things that you should be optimizing for, but you have to worry about things like grants, publishing. It ends up being this, you kind of game the system, right? By just optimizing for things that are not direct impact. But to be successful in a startup, right, you're measured by the direct value you bring to people, right? So that was really appealing to me. Ended up sticking around in crypto, and the rest is history. Now running a protocol called VEDA with a really strong team. We have really great product, and definitely don't regret that decision.
What was the protocol that you joined initially?
It's called Sommelier Finance. I don't know if you're familiar with it.
No, what did it do? I hadn't heard of it.
Yeah, it was effectively a DeFi yield aggregator. So if you know Yearn, familiar with Yearn.
I remember Yearn. I remember when Yearn was very early at Yearn. I knew about it. So
yeah, so same idea, right? The core principle is that DeFi is really complicated. People are not going to go directly into these complex protocols and manage their own yield. They're going to use passive options. So that's the spirit. That's kind of the spirit of VEDA to some extent. But I've been fortunate to have this kind of cohesive thread that I've been following since my entrance into DeFi at Sommelier. I feel like to some extent VEDA is really proving out this thesis finally after 3.5 years at this point.
Yeah, what happened in Sommelier? What was the story there? Just curious.
Yeah, Sommelier is a super interesting protocol. It's still around. It's still kicking. It's got some pretty good products, but effectively, what was unique about Sommelier was it was a Cosmos chain that's user base lived on Ethereum, right? So Cosmos was powering all the infrastructure, powering these products, decentralizing stuff, making it operate. But the smart contracts, the things that you use actually lived on Ethereum. So that probably wasn't the best design choice. I think there weren't a lot of options back then to some extent. Today you have things like Eigenlayer. You have a bunch of infrastructure that lets you be really expressive even within Ethereum. Back then, things were way less mature, right? So the Cosmos chain was almost necessary. So that was one learning point. It's Sommelier was right on a lot of things. And the execution, I think, was just hindered by the fact that it was too early, right? The infrastructure just wasn't there. DeFi wasn't kind of ready for it yet.
Mm-hmm. Interesting. Yeah. And so then it sounds like that you said this VEDA, the new thing, is really proving out that thesis. So what's different now, and why do you feel like it's proven out? What leads you to think that it's proving out the thesis, or what was the thesis? Maybe to reiterate that again.
Yeah. So the thesis is that DeFi, to put it very basically, is DeFi is back-end infrastructure, right? Things like DEXs, money markets, even fancy new stuff like yield trading, restaking. None of that is really meant to be distributed to consumers. but it really is going to be back-end infrastructure that powers the future of the financial system. The question for how you bring it to consumers is just that it's like, how do you package this stuff? Right. So our view is that what most people want is to earn yield on their crypto assets. That's like 99% of the use case in DeFi today. So the best way to deliver yield to a user is you package up DeFi into what effectively looks like structured products. We call them vaults. And it's a super simple interface. Users come to the smart contract, deposit their assets. Those assets are then deployed into the underlying yield protocols, whether that's lending, staking, liquidity provisioning, whatever. And the user is able to earn yield really simply while retaining the benefits of DeFi, right? They can see all of their assets. It's non-custodial. They know, it's not going to go the FTX route or the Luna route because you can see everything happening on chain. So yeah, that's the thesis. What we've done with VEDA is we've built this as a platform. So the view is that every financial application, even the ones that aren't DeFi specific, will have yield embedded directly in the interface. It's kind of like a no-brainer at this point. When you have stable coins or ETH or Bitcoin parked on an application, that should be by default yield bearing. So
Fuse Wallet is a really good example of what this looks like, I think, in practice. Have you seen Fuse?
I haven't.
It's the Squads protocol on Solana. Do you know that team at all? So they shipped another product called Fuse, and it uses like this MPC tech to secure the wallet, to make it still self custody. And then they have like yield bearing stuff built into it right away. But like users are totally unaware of like how all that works. You're just depositing, whatever Solar USDC or whatever into the app, and it starts earning yield.
Same idea, right?
And so your stuff is sort of like a platform that would allow any developer who wants to integrate yield bearing functionality into their app to do that.
Exactly. Whether you're, a fintech app, whether you're an exchange, a DeFi protocol, a chain, it's like if you have users coming and using your platform, your application, yield is going to be a part of that experience. And we're trying to make it really easy for anyone to do that.
Nice. And I'm just looking at your website. So it looks like you have like a couple billion in yield.
In
native yield?
TVL.
In TVL.
You just look at all the assets across all our contracts. We're north of 2 billion. We have about 100,000 users plus that are using. So this is why I think we're actively proving out this thesis. So some context, our protocol is a little over a year old. We launched March of 2024, and it's been a crazy year for the category. We've had all kinds of new participants enter who are building vaults. Vaults have become like sexy again, and they've proliferated across many different protocols. Hyperliquid has vaults, Morpho has vaults. They're kind of table stakes for new protocol launches. So yeah, it's been a wild ride. I think the category is one of the fastest growing ones, and we're fortunate to be the leader in the category today.
It's really interesting from a technical standpoint. There's just a lot I would like to dig into here, time permitting. But one of the big questions that I have for you has to do around like capital security. And you were mentioned like Luna and FTX, but the actual comparison that comes to my mind is more like Celsius. And it's funny because like I think like 2 weeks before that whole house of cards like collapsed, I was in Miami sitting next to the CEO of that company at some dinner that they had hosted, and I honestly didn't know much about them. I just like got invited through some friend or something to this thing, and I showed up and this guy sitting next to me, and then a couple weeks later that company had just imploded. And one of the lessons I learned from that whole FTX Luna Celsius thing is like whenever there's yield involved, there's risk.
Yep.
Right. There's some risk. And it's not something that I'd ever really thought about until I saw these things unwind, which may sound stupid, but for retail, like I think a lot of people were probably like me where they're like, oh yeah, I'm earning like whatever, 12%. Sweet.
Yeah.
Like that's all you see. So how do you deal with that? Like I'm reading some stuff on your website that's like, yeah, we're AI agents and stuff making strategies and people making strategies. And I think there's this thing called verifiable constraints on capital. Like how does this stuff fit together? Can you just explain this to me in simple terms, like how it's safe?
So I agree with Celsius, BlockFi. It's a great, like the success of Celsius shows you why this product category makes sense. It's like there's so much demand for yield on crypto assets.
The demand is no question. People want it.
Yeah.
Right.
Failure of Celsius shows you why this needs to be built in DeFi and not the way that it has been built previously, right? Like the biggest issue is when you have a source of yield that's opaque, like people don't know what's going on. It's probably hidden. It's probably like, driven by some hidden leverage or bad loans or something like that. That the incentives are just bad, right? Like what Celsius, nobody could actually see what was going on under the hood. And so users couldn't tell, right? They were just advertised this top line APY number. They're like, it looks good. They put their capital in, and turns out that the source of the yield was completely unsustainable. This is kind of like what was going on with FTX as well, right? Like the trading experience on FTX was sublime, but the reason is that it was being, subsidized. It was fake, right? Like it was being subsidized by this extremely unsustainable engine, like, liquidation engine is what they advertised it as. So the whole lesson here is that when you put things on chain, that's really the best possible user experience. Like you combine that product experience of, I want yield on my crypto assets with the transparency of DeFi, and you get something that's not, it's not possible to do something like what Celsius did, right? Like users of our products can see everything that's happening on chain. They can see when a position has, is underwater. They can see whether there's excessive risk being taken. So this is our view. It's like all yield products, right? All of asset management will actually end up moving on chain. Our perspective is that we're not actually building all of the strategies, right? There will be thousands, there will be asset managers. There will be thousands of curators is like the term that they call it these days in DeFi. We're building the infrastructure, right? So these are the smart contracts that make it actually possible to deliver this experience to users without sacrificing on transparency, right? The extreme version of like an on-chain yield product is you just take a multi-sig, like a DeFi fund, right? Like a DeFi liquid fund. That capital is just sitting in some multi-sig. There's no checks and balances. People can do whatever they want. And DeFi funds do blow up, right? So what we're building is different. A vault is this new primitive that is effectively an asset management primitive, right? People can deposit their assets. It has very specific checks on what can happen to those assets. Users can audit those checks and balances. Again, full transparency into what's going on. We're really trying to strike the right balance between capital efficiency, but making sure users have full transparency into what's going on. That's really the unlock here that's now possible.
Are those checks and balances like rules like 50% can be in this ETH strategy and 20% can be in some Sol strategy, like some, like there's just like different, you can put in this pool over here that does X, Y, and Z, but it's just like that, right? And is that human readable? I mean,
effectively, yes, right? It's like, this is the set of positions this product can take. If it's an ETH product, it just can't like leverage long some meme coin, right? Like you can physically see cryptographically that it can't do that. If there are allocation caps, people can see that. So it's just baking as many constraints as possible into the smart contracts. So I mentioned Yearn, at the kind of beginning here. One challenge with Yearn is they put way too much on chain, right? If you put the entire strategy logic on chain, what happens is you get front runners, copy traders, the strategy goes stale. So you do need to keep some alpha off chain for risk management purposes. So really there's kind of this is the challenge, right? How do you strike the right balance between having flexibility by keeping algorithms off chain, but giving users what they need by, making them verifiable on chain?
Interesting. So there is still some active management involved by whoever's doing it, and there's some knobs they can turn. Like, is there an interface for that? Or are you guys like kind of hard coding these different strategies and auditing them and putting them on, putting the components that need to go on chain? Like, how does that work?
Yeah, we're building a full stack platform for third-party curators to actually run the strategies on chain. So we have this interface that we've built that's pretty sophisticated. You can simulate transactions. There's a bunch of dashboards to see what's going on. There are strategies that are more automated. Again, we're kind of agnostic. I think there's going to be a whole universe of different kinds of strategies, some more active, some more passive. We just want to make sure that we're building a platform that can support all kinds of strategies, whatever the use case.
And talk to me about how this multi-chain stuff works. Like, modularity is a core part of your architecture, which makes sense. How do you do cross-chain operations? And is this only on EVM chains, or is it across other chains too?
We've historically been EVM primarily. We recently announced our expansion to Solana. So we've been working on our core architecture that's getting audited. It's almost ready, so we should have some pretty major announcements coming out there. The yield is not going to just live on EVMs. It's going to live all over the place. So Solana is next, just because that's one of the more exciting ecosystems. But we're always looking for new ecosystems. The cross-chain piece is really critical, right? Because this is one thing that's completely broken with DeFi UX today. It's like you try to bridge. Just the process of bridging is something that no normal person should ever have to deal with. How it should work is you deposit wherever you are, right? It's seamless, abstracted for you, and you're able to source yield from wherever it exists, whether it's on an EVM, non-EVM, whatever. The way we do that is we have this off-chain oracle that effectively looks at the smart contracts on each chain and sticks all of that together. This is actually one of the novelties of our architecture. We took our learnings from building these vaults over the last 3 years, and this oracle piece is critical. So that functionality, I won't bore you with the technical details, but that functionality is really, really important. It's one of the things that makes our products, some of the most usable and appealing on the market.
Yeah, really cool. It's a hard problem to solve. Abstracting away the different need to even know about what chain is what, especially for the user. And it kind of goes back to what you're saying. I'll be interested to hear, learn more about how the Solana integration has gone too, since you've been on EVM, and Solana is just a bit of a different beast, especially from a data standpoint. What kind of challenges have you guys run into with doing that?
Absolutely. It's such a different market structure. It's amazing. One thing that's been really interesting to see in Solana is the apps are way more vertically integrated, which feels like a no-brainer, from a business perspective. But in Ethereum world, almost nobody has had vaults historically. Now they're becoming really popular. But you go to Solana and it's like Drift has their own vault system. Camino has their own vault system. It's almost just like a given that if you're building some kind of primitive, whether it's a DEX or a lending protocol or whatever, you keep, you get as close to the user as possible. Meaning if your protocol is hard to use, you make it easier to use by building some tools on top of it yourself. So that's been pretty cool to see. That's one thing that's different. The liquidity, structures is way different. I think for all of the growth that Solana has seen over the last year, DeFi is still fairly immature. There's a lot of, inefficiencies in the market. Yields tend to be higher as a result of that. So it's been pretty interesting just from the DeFi perspective. Of course, the data model and transaction model and all of that stuff is completely alien. We've spent a lot of time, hiring the right people, understanding ourselves, just comparing and contrasting these things. So I do think that's another value prop for us here. It's for a newer entrant, right? It's really hard to have broad coverage across all of these different ecosystems. You just need so much expertise to do that. So I think that's one thing that recently I've discovered is probably going to be a competitive advantage for us.
Yeah, to go deep in a few, not every single one of them.
Yeah, and just get as broad coverage as possible, right? Because the broader our coverage, the better the yields are going to be, the better the platform is going to be. It's hard for...
Oh, I see what you're saying.
Yeah.
You mentioned the yields were better or higher because you said there was a liquidity issue. I forget the word that you used, but can you tell me a little more about what that actually means? What's the difference with how the liquidity market structure is?
It's just lower liquidity, right? There's less liquidity on DEXs. There's, I think more inefficient leverage. So these are the kind of things that result in organic yield opportunities. Let's say you're trying to market make stable coins on chain, right? In a healthy market, those rates will effectively go down to the risk-free rate, right? If you're holding USDC, USDT, it's not super risky. It shouldn't be significantly higher yielding than something like lending on Aave. I think those kind of efficiencies don't exist equally on Solana. So if you know where to look, there's a lot of opportunity at the right scale, right? It's, again, there's not a ton of liquidity, so it's hard to throw $1 billion today into Solana DeFi, but that'll improve over time. But for smaller sizes, it's pretty attractive.
But you're saying in the right places, right? So it's because when you say there's not a lot of liquidity, but then you look at the volume numbers, we see on Twitter or X or whatever, every other day, I feel Solana is bigger than every other chain combined in volume. How is it that there's different, like, can you explain the difference there? Like why are there liquidity gaps, or is it just specific parts of the market where there are liquidity gaps? Like, how does that work? Like, Solana is still earlier than ETH, for example. And I'm not saying this to be combative or that it's a bad or a good thing. I'm just like curious. I had no idea.
Yeah.
I honestly don't use DeFi products that much, as funny as it sounds like. So I'm not out there degening in messing around with yield. I stake my soul and that's about it.
There you go. That's what most people should do. But yeah, it's a good question. So there's volume, which is just people trading assets. And then there's the liquidity, which is how much capital is actually parked on these protocols to facilitate different activities. And I think there's the ratio of volume to liquidity is almost like the best indicator of opportunity size, right? So there's a ton of people using Solana, high volumes. There's not a ton of capital actually facilitating that usage, low liquidity. So it means there's an opportunity, right? Why there's not a ton of capital? It's harder to use. People don't understand it as well as they do Ethereum. This is where the alpha is, right? For the people who...
That's interesting.
Yeah.
That's super... I had not heard that. That's super interesting. And it's a pretty fascinating insight. I definitely feel like that is some alpha there. Especially for like any of these like funds, like on-chain, hedge funds and stuff who are looking for a little edge. That's an angle to check out. And it is interesting too, because when you think about like that is where Solana's growth it's a supply and demand problem. Like liquidity is supply, right? And there's a ton of demand for that liquidity to make these trades happen. But the demand has gotten so great. So that's the number everybody focuses on. It's another interesting thought that goes through my head is like, a lot of times you see people focusing on TVL, and that's not necessarily like the best metric, that sort of describes a market. It's like a metric, but it's not necessarily the best one that'll help you understand how healthy the market actually is that you're talking about.
Honestly, even if TVL is like a relevant number, not all TVLs are the same, right? So this is like a pet peeve of mine.
Right.
Even in Ethereum world, two assets, you can have $1 billion of asset A and $1 billion of asset B, and they could be totally different in the actual economic substance. So like a really valuable asset to have $1 billion of is like USDT or USDC, right? Like that's cash. That's people want to take leverage on that. People want to borrow on it. That's like paired against a bunch of different assets that people want to trade with. I'm not going to name names, but you could have some like random shitty asset that someone is minted out of nowhere. And sure, it's $1 billion of TVL, but like, who cares, right? It's not useful in any economic.
The UNI market made that one to $1 billion market cap on our own, just like wash trading.
Exactly. Yeah.
So it's actually worthless. Like it would nuke in a second if someone tried to sell $100 worth.
Yeah. And all of that gets washed away with the TVL number, right? Because it's like $1 billion, right? So yeah, we definitely need better metrics and ways of understanding what's going on.
Yeah. So what makes up your TVL?
We, again, like, we like to have high quality assets. So it's a mix of things like Bitcoin liquid staking tokens, ETH.
We like that.
Yeah. I'm a huge Bitcoin DeFi bull.
BTC is good. Yeah.
Yeah. It's a crime that BTC is not the largest DeFi asset today. It just doesn't make any sense.
I want to get in on the infrastructure stuff, man. I've had a couple of people on the show that are building some really fascinating stuff, like in the BTC L2 arena and like trying to, the Zeus guys they're the ones I know the best on Solana, they're bringing BTC to Solana. And I just think it's exciting. I think it's a really big opportunity. And I like the idea that you can earn Bitcoin through those by participating in those protocols, if you're providing liquidity or if you're like running a node or something on that network that's bridging it to Solana or something and you're earning some fees. I think that's pretty cool.
Totally. Yeah. And it's such an obvious opportunity, right? It's like you have this $1 trillion+ asset class that nobody can get yield on, right? Historically, like the thing to do with your Bitcoin is you just hold it. And there's no safe way to do it. Like you could put it on a centralized exchange, but a lot of people don't want to do that. People want to retain custody, right?
Yeah.
With DeFi, you can have the best of both worlds. You can generate yield in a transparent way and retain custody. It's just such a massive opportunity. Again, it's $1 trillion opportunity and it's like a complete no-brainer. So yeah, that's been cool. We have like probably $1 billion of Bitcoin in TVL. Maybe less now that the market's down. But it's been a big focus area for us over the last.
Market's back up.
Ish, yeah.
Back up. Ish. Yeah, it makes me think about like, so yeah, you guys integrating with some of the exchanges, you could look at Cube Exchange or Backpack, for example, and you could have self-custody end to end, and they get to participate in your yield products, like the users of those platforms could, and then obviously get some yield on their Bitcoin that way.
Exactly. And think about it from Backpack's perspective, right? Like they don't want, or any of these exchanges or wallets or distribution channels, there's a bunch of capital sitting all over the place that is not productive. And this is a great monetization opportunity, right? If they can provide 1-2% on Bitcoin and take 0.5% on that, that's huge for them as far as revenue. So it's just like a win-win all around. This is kind of our sales pitch, our value prop. It's like turn your passive capital into something that actually generates revenue for you and gives your users a better product experience.
And then, so are you guys do you guys have like a centralized revenue model, or how do you make money, or do you have a token? What's the deal there?
Yeah, we're a little flexible. So we're TVL focused right now. We've explored different kinds of revenue models, whether it's like, our percentage of assets in the vaults that gets charged automatically in the smart contract. If you look at the extreme of the most scalable version of what we're building, it looks kind of like a SaaS company. So I know it's super unsexy to build SaaS.
I think it's great
in DeFi, but
it's great.
Yeah, there's going to be thousands of these products, right? Tens of thousands, hundreds of thousands, and building our platform in a way that anyone can, with a single click, embed yield into their UI, whether it's sexy or not, I think that's the biggest possible impact.
It's totally okay to build a business and make money.
I know it's our revenue's bearish. Building real products is bearish, but we do what we got.
Yes, I like it a lot. It survives multiple markets, and all the other people who get wrecked are building their next thing that's going to get wrecked, and you're still building the same company.
Yeah,
so you'll be happy you did that. Out of curiosity, just like we're kind of getting towards the top of the show here. What's something that I haven't asked you that we should have talked about, or that you wish we had talked about?
I think one thing that's just broadly contextualizing where we're at in DeFi. So again, I've been here since basically the height of DeFi in 2021. So I've seen what it looks like when the world is paying attention and money's flowing and everyone's rich and happy. And I'm way more bullish and excited on DeFi today, about DeFi than I was back then. And there's a couple of reasons. So the first is that DeFi is finally at this point where we have this set of primitives that we know are secure and scalable. Like that wasn't the case a couple of years ago. One feature of 2021 is that like a lot of people got wrecked and just hacked, and all the tokens went up. So it's like people were able to make up for it and they stuck around. But we saw what happened when markets crashed. That's not the case today, right? There's really successful battle-tested protocols that a lot of people like get value from on a day-to-day basis. So the infrastructure is ready, to put it shortly. And the other point is like we're finally getting to a point in regulation where people can take, people can take experiments, right? And actually try to offer these products to the real world. That combination is just huge. So we're seeing it today. I think a lot of people are really excited about this. I think DeFi is finally at a point where it's ready to be exported to like normal people, and not just the set of like power users and whales and degens that exist today. So yeah, this is basically drives every aspect of our business and how we approach things. It's like our objective is to package up DeFi and distribute it to the world. And I think there's no better time to do it. So yeah, for people who are like wondering whether, DeFi is the right place to be, I genuinely think this is like DeFi's moment. We're going to see that play out over the next 12 months.
It does feel like an inflection point. And if you can get it into more user-friendly applications, you'll see a big jump in usage. That isn't just like people like you and me who would go through I remember like the last time I used any kind of yield farming thing was Pangolin Exchange. Do you remember that? Pangolin Exchange on Avalanche? Yeah. And so I bridged some ETH to Avalanche, and then I had to go to like this other Avalanche chain and like stake it on the Pangolin thing.
I was going to do that.
And, it was like 8 steps, and every step there was like this 15-minute like, oh fuck, where'd my money go? Yeah. and then eventually it started printing, and then I started using Solana, and it was like I remember I guess this was the last time I used one of the, I can't remember what it was, like one of the early DeFi protocols on Solana, and it was just a yield farming scheme. And I just did it for fun. I just but it was like click deposit, ticker starts going up. You know, they had like one of these little things that just like the numbers were just going up, and that was addicting, right? You just sit there and watch it go ching, 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 and that made it fun. But like before that, it wasn't fun. It was like this experiment that felt super risky, you know, where you're just like YOLOing money.
Yeah, that's a great answer. That's exactly that's the only way it'll be successful, right? Like you have.
Yeah, it's got to be fun.
Yeah, it's got to be easy. It's got to be fun. But again, without,
or boring. It can be fun or boring, but it can't be scary.
Yeah.
All right. Well, thanks so much for coming on. It's been awesome having you.
Yeah, thanks for having me. This is great.